Before we start, let's talk about something important happening in the financial markets right now. In March of 2026, the Federal Reserve will hold one of the most closely watched meetings in years. And depending on what happens in that meeting, it could force markets to completely rethink the direction of the economy. Interest rates, inflation, recession, risks, stock valuations, housing prices, all of it ties back to one question: what will the Fed do next? Because when the Federal Reserve shifts policy, it doesn't just move the interest rates. It moves the entire financial system. So in this video, we're going to break down why this particular Fed meeting matters so much, how markets are positioning for it, and why the outcome could trigger a major shift in the economy. All right, let's get right into it. Let's start with a simple question. Why do financial markets pay so much attention to Federal Reserve meetings? After all, the Federal Reserve only meets a handful of times each year. But during those meetings, a small group of policymakers can make decisions that influence everything from mortgage rates to stock prices to the global financial system. And sometimes those meetings become turning points, moments where markets suddenly realize that the economic environment is about to change. The March 2026 Federal Reserve meeting may be one of those moments, because right now, the Fed is facing a problem that central banks throughout history have struggled with, a problem with no easy solution. The Fed is trapped between two competing risks: inflation and recession. To understand why this meeting matters so much, we need to look at how the Federal Reserve actually operates. The Federal Reserve's primary tool for influencing the economy is interest rates. When the Fed raises interest rates, borrowing becomes more expensive. Mortgages cost more. Business loans cost more. Credit card interest rises, and that tends to slow down spending and investment. The goal of higher rates is usually to slow inflation, because when borrowing slows, demand across the economy tends to cool down. But higher interest rates also come with side effects. When borrowing costs rise, businesses often reduce hiring. Consumers delay large purchases. Housing activity slows, and eventually economic growth can weaken. In other words, raising interest rates can help control inflation, but it can also push the economy toward recession. Now, fast forward to where the economy stands today. Over the past few years, central banks around the world raised interest rates aggressively in an effort to control inflation that surged during the early 2020s. Those rate increases were among the fastest tightening cycles in decades. And while inflation has cooled from its peak, it hasn't disappeared completely. Some areas of the economy are still experiencing persistent price pressures. Housing costs remain elevated. Certain service sectors continue seeing strong wage growth, and global energy markets remain volatile. That leaves the Federal Reserve facing a difficult decision. If the Fed cuts interest rates too early, inflation could accelerate again. But if the Fed keeps rates high for too long, the economy could begin to slow sharply. Financial markets are now trying to predict which path the Fed will choose. And those expectations are incredibly important, because markets don't just react to what the Fed does. They react to what investors believe the Fed will do next. Right now, the biggest question investors are asking is this: will the Fed begin cutting rates in 2026? Or will policymakers keep rates higher for longer? At first glance, that might sound like a technical debate among economists, but the answer affects nearly every part of the financial system. Stock markets tend to perform best when borrowing costs are falling. Lower interest rates make it easier for companies to invest, expand, and refinance debt. Investors also tend to move money into stocks when safer assets like bonds produce lower yields. But when interest rates stay high, the math changes. Higher rates increase borrowing costs. Corporate debt becomes more expensive to manage. Consumers face higher monthly payments, and financial assets must compete with higher returns available from safer investments. This is why stock markets often become extremely sensitive to changes in interest rate expectations. And it's also why certain Federal Reserve meetings can become major catalysts for market volatility. But there's another layer to the problem, and it has to do with how financial markets behave during periods of uncertainty. Over the past several months, markets have been trying to price in multiple possible scenarios at the same time. Some investors believe inflation will continue falling. If that happens, the Fed may feel comfortable lowering rates to support economic growth. Other investors believe inflation may remain stubbornly high. In that scenario, the Fed may keep rates elevated for much longer than markets expect. Hey everyone, sorry to interrupt this video, but real quick, if you want to take full advantage of tax liens and deeds and you don't know where to start, and you want the full blueprint of how to make money in these auctions, how to register them, bid on them, make money from them, and get that mailbox money yourself, links down below to the entire program, and I'll throw a sale link down there so you can take advantage of this right now. Now, back to the video. When markets struggle to agree on which scenario is more likely, volatility increases, because every new economic data release begins to influence expectations. Inflation reports, employment numbers, consumer spending, manufacturing data. All of these indicators feed into the same question: what will the Federal Reserve do next? That's why the March 2026 meeting carries so much attention. Investors aren't just looking for a rate decision, they're listening carefully to the signals behind that decision. Federal Reserve statements, press conferences, economic projections. Small changes in wording can sometimes move markets dramatically. For example, if the Fed signals that inflation risks remain elevated, markets may interpret that as a sign that rate cuts will be delayed. But if policymakers emphasize slowing economic growth, investors may begin expecting earlier rate cuts. And those shifting expectations can move trillions of dollars in global capital. But the real risk comes from something economists call a policy mistake. A policy mistake occurs when central banks respond too aggressively or not aggressively enough to changing economic conditions. If the Fed cuts rates too soon, inflation could reaccelerate. If the Fed keeps rates high while the economy weakens, financial stress could begin spreading through the system. History shows that both scenarios have happened before. In the 1970s, premature policy easing allowed inflation to return repeatedly. In other periods, central banks kept policy too tight during economic slowdowns, deepening recessions. The difficulty is that policymakers must make decisions based on incomplete information. Economic data always reflects the past. By the time policymakers see clear evidence of a slowdown or inflation surge, the underlying forces may already be shifting. That's why markets often react strongly to even small signals from the Federal Reserve. Investors are constantly trying to anticipate what the central bank will do before it actually happens. Now, here's where things become especially interesting. Financial markets themselves can influence the economy. If markets believe interest rates will fall soon, borrowing conditions may begin easing even before the Fed takes action. Stock prices may rise, credit conditions may loosen, consumer confidence may increase. But if markets believe rates will remain high, financial conditions may tighten even further. Stock prices may fall, borrowing costs may rise, business investment may slow. In other words, expectations alone can shape economic outcomes. And that feedback loop is one reason why Federal Reserve communication has become so important. Modern central banking isn't just about changing interest rates. It's also about managing expectations, guiding markets, and maintaining confidence in the stability of the financial system. So when analysts say a Fed meeting could break the market, they don't necessarily mean markets will collapse overnight. What they mean is that a shift in expectations could force markets to reprice risk. Investors may suddenly adjust their assumptions about interest rates, economic growth, and corporate earnings. And when those assumptions change quickly, markets can move very rapidly. The March 2026 meeting sits right at the center of that uncertainty. Inflation is no longer surging the way it once was, but it also hasn't fully disappeared. Economic growth remains resilient in some sectors, but other areas are beginning to show signs of slowing, and financial markets are balancing between optimism and caution. That combination makes this meeting particularly important, because the signals coming out of the Federal Reserve may influence how investors position themselves for the next phase of the economic cycle. Will the Fed begin easing policy? Will policymakers stay cautious? Or will markets realize that the path forward is more uncertain than they expected? Those questions are exactly what investors will be watching when the Federal Reserve meets in March 2026. And the answers could shape the direction of financial markets for months to come. If you found this breakdown helpful and want more videos explaining how central banks, markets, and economic cycles interact, consider subscribing.